Okay, let's get started. So I know that I don't have to tell you this because this you have it on your calendar all through the semester. Next week is spring break, right? Yeah? So if you want to come to class, you're welcome. They actually, for whatever reason, they keep the webcast going during the spring break. So I get a notice saying class starts in 5 minutes. But there is obviously no class next week, which is, so have fun. But at the same time, try to catch up as much as you can before you leave. On two things. One is, of course, the big project, which is, if you can keep it moving, that's good. The other is the case that I sent you on Monday, right? So it's a group project. I mean, it goes without saying, you turn in one report per group. It's actually it's a project that forces you to think about corporate finance, about building up modeling skills. So it's a kind of skill set builder. So if you can actually get started. You don't have to wait till you come back from the break. You can actually get started on pieces of the case. Start by at least reading the case before you leave, so that at least you have a sense of what needs to be done. It's due on March 29th before class. Why before class? Because we will be talking about my solution to the case on March 29th. Not the solution, but my solution. And by then, obviously, the project reports or the case reports have to come in. There are about probably 30 quizzes that have still not been picked up. And after 31 years, I can guarantee you that most of these will never get picked up. And the people who don't pick up quiz 1 will also not pick up quiz 2 and not pick up quiz 3. There's this weird psychological thing going on, which is if you don't see it, it hasn't happened kind of thing, right? It's a denial is so rampant, you don't want to deal with it. My suggestion is you get over the denial and deal with it for the simple reason that you might want to check my grading. I might have given you a point less or a point and a half less than you deserve. So take a look at the quiz, pick it up, check it against the solution. If you have any issues, as I said, bring it in, we'll talk about it. So today we're going to complete cost to capital. It took us a while, almost half the class, right? So we're going to come up with that minimum acceptable hurdle rate. So let's see where we are. We have a cost of equity for a company. Somebody remind me again what drives the cost of equity. Sam introduced himself to me in the elevator, and now he's wishing he hadn't. So now I'm going to pick on him. Sam, what goes into a cost of equity?
The risk-free rate.
Risk-free rate, which is a function of the currency you're doing your analysis in, the beta, which measures the business or businesses you're in, and the equity risk premium that measures what? Not where the company is incorporated, but where it does business. So those go into the cost of equity. Last session, we also talked about the cost of debt. What goes into a cost of debt? Same risk-free rate, so you start there.
That was actually out of it.
Okay. So on top of that risk-free rate, you add a default spread. Why a default spread? Because if I'm lending money to you, I want to make sure I cover the potential that you will not pay me back. And then you have this one advantage with debt, which is a tax advantage, so you multiply by 1. So that's where we left off. You have a cost of equity and a cost of debt. And thank God, for most companies, that is where the bulk of your capital will come. But there are two other ways you can raise capital that can be a pain in the neck. The first is preferred stock. In the US, preferred stock is stock with a fixed dividend. It's essentially like a bond. It looks more like a bond than a stock because the dividend is fixed up front. It's not quite guaranteed. That's the first difference. So if you don't get paid preferred stock, you can't push a company into bankruptcy, but they might have to turn over some voting rights to you if that happens. But what's a big difference? If preferred stock is a lot like debt in the US, why don't we just lump preferred stock in with debt when we do the cost of capital? What's the catch in doing that?
Bonds still have preference when the company pays.
No, but so let's think of this as junior, very junior debt. I could just attach a higher cost of debt to it, right? And throw it in. What do I get when I make interest payments, though? A tax deduction. If you pay preferred dividends, it has to come out of after-tax income. So if it's debt, it is actually very inefficient debt because you get all the downside of debt, the fixed payment, and you don't get any of the upside. So if you were actually building up capital from scratch, no company should ever use preferred stock. It's actually a very inefficient way of raising capital. So why do companies issue preferred stock? I mean, if you can issue debt, and you can get the tax deduction, what's the point of issuing preferred stock? There are two groups of companies in the US that issue preferred stock, and as you look at those groups, you should see the reason. The first is financial service companies. 85% of the preferred stock in the US is issued by banks and other financial service companies. Why? What is it that banks gain by issuing preferred stock that they would not gain if they issued debt? What are banks governed by? Regulatory capital ratios, right? If you don't have enough regulatory capital, you cannot operate. Preferred stock is actually counted as part of regulatory capital. So what you get is the benefit of issuing equity but it's actually, it's a silly reason to issue preferred stock, but you're doing it because it meets a regulatory capital requirement, but it actually comes with big dividend payments. The other group of companies that issue preferred stock tend to be very young companies, money-losing startups. And why do they issue preferred stock? Why do they not care about whether it's preferred stock or debt? If it's debt, they get interest expenses, right? Interest expenses are tax deductible for these companies, which are losing money. What's the point of the tax deduction? So with very young companies, you might see preferred stock simply because hey, there's no difference between debt and preferred stock for them, and at least they won't be pushed into default with preferred stock. The cash flows at least accumulate. So for your company, here's the first thing I check. Check through your capital. If you have no preferred stock, say thank you God and let it go. If you have a little preferred stock, say act like it. You remember the denial thing we talked about? Let it run rampant. Don't say I don't see preferred stock. So if it's a small amount of capital, but if it's 20, 25, 30% capital, you have to separate it from debt and equity. It's a third way of raising capital, and you have to give it its own cost. So with cost of equity, we said risk-free rate plus beta times risk premium, right? Cost of debt, we said risk-free rate plus default spread. You say, what's the cost of preferred stock? It's actually very simple. All you have to pay in preferred stock is the dividend. That's it. There's no price appreciation component. So if you take the dividend you promised in the preferred stock and divide by the preferred stock price, that's called a dividend yield. You got your cost of preferred stock. You don't have to multiply by 1 minus t. There's no tax advantage. You have a cost of preferred stock. It's out of the way. So that's preferred stock. These are called hybrid securities. They're called hybrid securities because they share some characteristics with equity and some with debt. There's another type of hybrid which more of you will run into, and these are convertible bonds. Somebody remind me how convertible debt works. What happens on convertible debt? No. So if I issue convertible debt, what have I done?
You've given an option to the counterparty?
To the bondholder to do what? To convert them into equity at a fixed price. So a convertible bond can actually be broken up into two securities. There's a straight bond, the conventional bond, plus a conversion option. The straight bond is debt. The conversion option is equity. In fact, there are some companies that issue convertible debt where it's mostly conversion option and very little debt. Tesla, when it issued its first convertible bond, issued it with a coupon rate of 1%. Now think about it. If there were no conversion option, what would you pay for a bond issued by a money-losing company that might not make it, which is giving you a 1% coupon? A very low price, right? But because there was a conversion option, it traded at a high price. If you have convertible debt, break it out into its debt and equity components, throw the conversion option into equity, the straight debt portion into debt, and move on. You're done. You've taken it off the books as a hybrid. So those are your three ways of financing. Debt, equity, or hybrids. For most of you, it's just going to be debt and equity. Last piece of the puzzle is I need weights on debt and equity.
The convertible part, do you mean, like, say, the option, what the option is trading at?
Exactly. You see, you won't know all you can observe is the total price of the convertible bond, right? You don't see how much, but there's actually a very simple way to separate how much of it is option. Just forget it's convertible, act like it's a straight bond. Say, how much would I pay for a Tesla bond with a 1% coupon rate? And the answer might be $123. The bond is trading at $1,123. Your $123 goes into bond, the remaining $1,000. So you don't even have to use an option pricing model. Just take the price of the convertible bond and subtract out what a straight bond would be worth with exactly the same coupon characteristics. Now comes the final piece of the puzzle. I have a cost of equity and debt. I need weights on the two. The rule in all of finance is very simple. The weights should be market value weights. Market value of equity, market value of debt. As opposed to what? On a balance sheet, you see a debt and equity number, right? Those are book value weights. You never, ever, 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 have I been emphatic enough? Ever use book value weights. And you'll be amazed at how many companies continue to use book value weights. Half of all US companies use book value weights to come up with cost of capital. And they come up with all kinds of cockamamie reasons as to why this is okay. So I'll throw some of the reasons at you, and we'll just dismantle them as we go along. The first argument you will hear from CFOs who want to use book value weights is, it is more reliable than market value. You know why? Because it doesn't move as much. Which part of that statement is true? It doesn't move very much, right? In fact, we know how often book values move. With a US company, how often does the book value change? Once every 3 months, every time you do a balance sheet. So you're right. It's more reliable. In fact, if you want to make it even more reliable, what should you do? Do your books less often. Every 6 months, it gets more reliable. Why not just stop doing your books altogether? It's absurd, because to argue that something is reliable because it doesn't move is like arguing that the thermometer that's always stuck at 98.6 degrees is more reliable than one that kind of shoots around. You'd be dying of a fever, and I stick that first thermometer, you're okay, just before you die. So let's dispense with that, right? It is true market value is more volatile than book value, but at least markets are trying. Accountants have given up. So it's not more reliable. The second argument you will hear from CFOs is they're just being conservative. Really? Okay. Let's play this out. You know what the typical market value of equity for a typical US company, how much the market value of equity is relative to book value? Last year, the price to book ratio, market value of equity to book value, was about 2.5 to 3. So you have $1 in book value, your market value is 2.5. The debt, on the other hand, trades at pretty close to book for the average company. So when I use market value weights, I use a high value for equity and a low value for debt, and I get a low debt ratio and a high equity ratio, and I compute a cost of capital. You're being conservative, right? So what do? You use a much lower value for equity. You actually weight equity less and debt more. You might say, so what? The cost of debt is much lower than the cost of equity. So if I weight equity less and debt more, my cost of capital goes down. And that doesn't strike me as conservative, that you're walking around thinking your cost of capital is a 5.5% cost of capital, and you're taking projects on that basis. So it's not more reliable. It's not more conservative. Here comes the last defense. One of the numbers we're going to compare the cost of capital to is a number called the return on capital or return on equity. This is an accounting return which is computed as income divided by book value. And it's absolutely true that we compute accounting returns using book value. So their argument is we compute the returns based on book value. Why shouldn't you also compute the cost of capital based on book value? Because we're measuring two different things. When we look at historical returns on capital, we look at old projects, how much you invested in them then, and what you made as a return on those projects. When we look at the cost of capital, we're kind of updating and saying, hey, I have capital tied up in these projects. What can I make elsewhere on that capital today? It's a different question, and market value answers that question much better than book value. There is no good reason for using book value weights. You see, what if I have a private company? Do you see why for private companies people sometimes fall back on book value? Why? Because there is no market value. You say, I can't get a market value. Even for private companies, I'm going to argue book value is the worst of ways to compute a cost of capital. So I have to do this for Bookscape. When I do my cost of capital, I'll explain what I had to do because I didn't have market value, but I will not use book value. So I need a market value of equity and a market value of debt, right? If I take a company like Disney, where do I get market value of equity? I take share price times. Market value of equity for a publicly traded company should be easy to get, right? It's a market capitalization of your company. How do I get market value of debt? If I issue bonds and they're traded, I can try to get a market value of debt. But let's face it, most companies, even companies that issue bonds, have a significant portion of their debt that is not traded. It's bank loans. So it's much more difficult to get market value of debt than it is to get market value of equity. Do you know what the typical calculation assumes? For market value of equity, they use the market cap. Then they get to the debt and they do a little dance. They say it's too difficult to get market value. Therefore, we're going to use book value. So in almost all of practice, here's what you will see mixed up. A market value of equity and a book value of debt. You see this in computations like enterprise value ratios, right? You take market value, you're supposed to be adding market value of debt, but because it's so difficult to get, you throw up your hands, now I'm going to use book value. And most of the time, you will get away with it. But sometimes, it's going to mess you up. So if you can, you should be trying to compute a market value of debt. And I think you can actually compute a market value of debt even for non-traded debt. I'm going to take Disney and illustrate this process because, in a sense, what I'm going to do is take the market and... Did I skip a page? No. I'm going to take their book value of debt and try to convert to market value. As I go through this process, start thinking about any company. It doesn't have to be Disney. Do you know how to compute the market price of a bond? What do? You take the coupons and the face value on the bond, which are given. Then you discount them all back at today's market interest rate. You have a market value for a bond, right? Disney has $14.288 billion in book value debt. So that's what they show on the balance sheet as debt, interest-bearing debt. Their interest expense in the most recent year was $349 million. So out of the income statement, I got the interest expense. Out of the balance sheet, I got the book value of debt. And most companies, especially in the US, if you go to their footnotes, break out when the debt comes due. How much debt comes due in 1 year, 2 years. Maybe not for all of the debt, but Disney broke down the maturity for at least $12 billion of the debt, and the weighted average maturity of that debt was about 7.92 years. What do I mean by weighted? I looked at when the debt came due and computed on average when the debt, on a weighted average when the debt came due. So here's what I have. I have $14,288 million book value of debt. I have $349 million in interest expenses, and I have a 7.92 year maturity. You might not remember, but last class I computed the pre-tax cost of debt for Disney by looking at the rating. With a single A rating, I said the cost of debt was 3.75%. Here's what I'm going to do. I'm going to take all of their debt and act as if it's a gigantic coupon bond with the following characteristics. With a face value equal to the book value, $14,288, that's not due till 7.92 years from now, and a coupon of $349 million. That's the interest expense from last year, continuing for the next 7.92 years. If you're saying, what the hell is that equation? I've never seen it before. You know what that is? I get $349 million every year for the next 7.92 years. That's the present value of an annuity. If that intimidates you, that's what you do. When you hit payment NNR on your financial calculator, that's what's happening in the background. That's the present value of the coupons for the next 7.92 years. The second term of the equation is the face value coming back at the end of the 7.92 years. If I add those two numbers up, I get 13.03 billion. You're saying, what does that even mean? That is my market value for the debt that Disney has on its books. I'm going to ask you a question. This actually doesn't require any serious math thought. I just want you to think in terms of common sense. The market value of debt for Disney is lower than its book value, right? What has to be true for the market value of a company to be roughly equal to its book value? What is the driver of why I get a discount in some companies, a premium in others? What has to be true?
I was thinking, the yield to maturity needs to be equal to the...
Yep. The interest rate, exactly. If my interest rate, in fact, what I can do is take the interest payment here, 349 million, and divide by 14,288. That's called a book interest rate. If the book interest rate is roughly equal to 3.75%, that's like having a bond that the coupon rate is equal to the interest rate. And when a bond, the coupon rate is equal to the interest rate, the price is going to converge in book value. Here my book interest rate is about 2.75%. My market interest rate is 3.75%. My market value of debt is going to therefore trade at a discount on book value. And I've already given you an insight into when using book value of debt is going to get you into the most trouble. I don't know whether any of you is doing Valiant. Valiant has $31 billion in book debt. But what's Valiant going through right now? Some financial distress. Their rating has dropped from when they issued the debt. When they issued the debt, they were a highly rated company. The coupon rate reflects the interest rate that was set when they were a healthy company. Now they become distressed. So if I use today's market interest rate in Valiant, which is about 2 to 3% higher than the rate at which they borrowed at, guess what? The market value of my debt at Valiant is going to be much lower than the book value. That's why I think it's a good idea to do this for all companies so you don't get sloppy. You've converted book debt into market debt. That takes care of the interest-bearing debt on the balance sheet. What's the other thing we said we're going to treat as debt? Lease commitments. Remember that? Because they're contractual commitments. In the case of Disney, here's what the lease commitment table for Disney looks like. And this is actually a table you will find for every company. It's pretty much global right now. So while lease expenses are treated as operating expenses, you go to the footnotes. This is what Disney tells me they have as contractual lease commitments in year 1, year 2, year 3, year 4, year 5. And beyond the 5th year, they give me a lump sum of 1,784 million because you are not required to break out after year 5. So I took the first 5 years out of the table. Then I took the 6th year's lump sum of 1,784. And given the average lease expense over the first 5 years, I tried to figure out, is it a 5-year, is this 7-year? So basically, I ended up giving it a 5-year annuity of $357 million a year for the 5 years. So basically, I'm breaking out the 1,784 into 5 annual payments. And then I discount them all back at the pre-tax. Now do you see why I had to sequence things the way I did? I need a cost of debt, or I'm kind of stuck when I get to this stage. I discount them back at a pre-tax cost of debt. You say, why pre-tax? Why not after tax? Because there's a pre-tax lease payments. It's just a matter of being consistent. What I get as a present value is $2,933 million. What does that mean? I view this as the equivalent of having borrowed $2.933 million. And from this point on for the rest of the class, if you ask me how much debt does Disney have, I'm not going to give you the $13.03 billion. I'm going to take the $13.03 billion and add the $2.93 billion to give you a total debt outstanding at Disney of $15.96 billion. This might seem like, why are you going through this extra level of detail? The reason I have to do this, if I gave you a Target or a Walmart or a Gap, this is the bulk of your debt, is lease commitments. The Gap, I think, is $1.5 billion in conventional debt. It has $6 billion in present value of lease commitments from debt. Starbucks has a couple of $1 billion in debt. It has almost $8 billion in lease commitments as debt. Your view about a company will change dramatically when you capitalize leases and bring it into debt. And you're just getting ahead of the game here. Because in 2019, accounting rules will require all companies to do this on all their leases. And it's about time. Why is it about time? I actually was on a panel a few months ago. It was an accounting panel about lease commitments. And I was able to unearth a previous panel that had met at NYU, it wasn't called Stern then, to talk about why lease commitments should be treated as debt. You know when that panel met? 1949. I am not kidding. This is the lag between when accountants know there's a problem and when the problem gets fixed. It's going to be 70 years if everything goes according to plan before they finally do the right thing. You can't wait for accountants to come to their senses. So you got to do it ahead of the time. In this case, this is debt and I should treat it as debt. Again, just to make sure that, yeah, go ahead.
You used 3.75%.
Yeah.
And you're saying that was based on their default
The rating.
their rating. If we were able to get a rate based on a better measure, like the market,
whatever you decide up front, so make that decision. When you get to the cost of debt, you can use the actual rating, you can use a synthetic rating, you can use a traded bond. Make your pick and then stick with it all the way through. So don't go back and forth between the two choices because it's really going to get you into trouble. Yes?
If you consider operating leases as debt, so when we calculate the interest coverage ratio, we should consider the implied interest as part of the interest expense.
That's actually a very good point. If you're doing a synthetic rating for a retail firm, remember how we used interest coverage ratio, operating income divided by interest expense? Retail firms are going to look like AAA rated companies because they don't have conventional debt. Because much of their debt is this lease debt. You actually have to compute it's actually going to create a circular reasoning problem for you because to compute the interest expense you need the present value of the leases, and to compute the present value of the leases you need the interest expense. Don't worry. That's why there's an iteration box in Excel. And in fact, my rating spreadsheet, if you use it to compute a rating, does go through that loop to make sure that I have a rating that actually is consistent with treating leases as debt. But I want everybody to be quite clear about why we're treating leases. What is it about leases that makes them debt? They're contractually committed, they're tax deductible, and I'll give you examples of how this extends out. Anybody here doing Netflix? Don't worry, I'm not going to ask you a specific question, but when you get a chance, go to the footnotes for Netflix where they give you the lease commitments. They'll actually have two columns. One will say lease commitments, and the next will say content commitments. And the content commitments are huge. It's $3.5 billion, $4 billion every year for the next 5 years. What are those content commitments, you think? How many of you have Netflix? Okay. You open up, you see all these movies they offer, right? How the heck do they get the rights to these movies? They go to the content providers and they say, we want the rights to the movies for the next 4 years. And guess how the contract is structured? You have to pay fixed amounts for the next 4 years. Those content commitments for Netflix, if you treat them as debt, will change your perspective on Netflix. It's a much riskier company than you realize because those content commitments are fixed costs. They're like debt. And if I were Netflix, I would be very careful about going out and borrowing money on top of those content commitments because you're going to very quickly tip over into distress. So content commitments are like that. And to show you how far I stretch this definition, I'm a Yankee fan. And I'm looking forward to baseball season. But I remember at the start of the 2009 season, the new Yankee Stadium was built. And I decided that I wanted to take my kids to Yankee Stadium. At that time, they were still kids. So that they could tell their children, I was there on opening day. So I offered this to all 4 of my kids, and I had to knock my daughter off the list. Because here's the question she asked me, will there be Dippin' Dots there? I said, I have no idea, Kendra, and I'm not paying $100 for a ticket for you to go around looking for Dippin' Dots. I'll find you Dippin' Dots somewhere else and just get you for like $2. So she was off the list. She didn't mind. So I took my 3 sons, and we sit in the bleachers. Now, that's all I could afford for opening day because every seat was going like $500. And it's a day game, obviously. That's why it's called opening day, not opening night. And I watched the Yankees run onto the field because as the home team, you come onto the field first. And as they ran onto the field, all I could think about was debt and equity. You're saying, this is sick. You're at Yankee Stadium. What the hell are you doing? thinking about debt, because here's what I saw. Right behind the plate was a guy called Jorge Posada, who'd been promised $13.5 million every year for the next 3 years. Contractually committed? Yes. Baseball is the worst of all sports to be an owner, because if you commit to paying somebody, you're stuck with it. Whether they play a day, whether they play in the minor leagues, whether they break their knee. So $13.5 million every year for the next 3 years. That's about, present value terms, is worth about $36 million. On to first base ran a guy called Mark Teixeira, and what I saw was $22.5 million every year for the next 8 years. It's like a $150 million bond running onto first base. At shortstop, at second base was my cheap infielder at that point in time, a guy called Robinson Cano. $7.5 million for the next 4 years. Then I swung around to shortstop. It was Derek Jeter. $19 million for only 2 years. Why? Because his contract was, so that was the good news, only 2 years. Then I looked at third base, and there was some imposter there that day. Because the guy who was supposed to be there was a guy called Alex Rodriguez, and his contract was $27.5 million every year for the next 9 years. I stopped right there. It's too depressing. Because then on the mound ran on CC Sabathia, $23 million for the next 7 years. Now, I didn't do this while I was in the game. That would have been sick. When I got home, I computed the present value of the commitments that the Yankees had entered. Just in the, forget about the outfield. Just the infield, the present value of the commitments, $561 million in commitments right there in the infield. You think those horrible baseball. If you're an AC Barker fan, next time the team runs onto the field, say, there's Messi. That's $70 million right there walking out there, right? So there's Neymar right now. So in a sense, as you go down the list, you're going to find that when you start thinking about these commitments as debt, which is what you should be doing, it's going to change your perspective on how levered these teams are. And if you are buying the Yankees, you got to factor this in, as if it were debt in valuing the Yankees. Yes?
Talked about content commitments as debt.
Yep.
How do you look at like contractual agreements versus suppliers?
Purchase obligations can vary. So it's a question of how much flexibility you get to back out. The more flexibility you have to back out. So for instance, if you have purchase commitments but they're conditioned on you being around and selling stuff, then I might cut you some slack and say they're not quite debt. So there is this subjective component that comes in on some commitments, but I'm going to start off and make sure I ask that question before I decide not to include it. Because when companies enter into these long-term commitments, they think it's costless. What's the big deal? I've locked in my contractor for the next 5 years, but the contractor's also locked you in for the next 5 years. And that's a riskier proposition than having more flexibility. Yes?
What about the insurance that they take out on players?
That's basically, you can take insurance, and if you can buy insurance against bonds too, right? So basically, that doesn't make the debt go away. It just means that when I value the company, I'm not as affected by an injury as I might otherwise have, but I still have to pay the person. The only thing I wasn't sure about is what would happen if you didn't meet one of these commitments. With lease commitments, we said you go bankrupt. That was settled for me when the Pittsburgh Pirates, a while back, had a problem paying Mario Lemieux, who was at that time one of the leading players. And they were required to turn over 25% of the ownership of the team to him because they couldn't make the payment. That kind of settles the deal. I'll give you a scary thought if you're a Los Angeles Dodgers fan. There was a point in time when Manny Ramirez was owed a significant amount of money by the Dodgers. Can you imagine Manny Ramirez being part owner of a team? If you don't know who Manny Ramirez is, let's let it go. Now, but if you're a baseball fan, this is perhaps the scariest of all things to think about, is Manny Ramirez being an owner of a baseball team. So at this stage, I want to summarize. So market value of debt is both interest-bearing debt and lease commitments. I get the value for the debt. So at this stage, I have a value for the equity, I have a value for the debt, and if I have preferred stock, I have a value for the preferred stock. I compute weights. You know what I mean by weights? Just add up the numbers and divide each one by the total. You're going to come up with weights. The only requirement that I beg of you is that those weights add up to 100%. Because otherwise the whole thing is going to come apart. So that's where we're leading. How much of my debt comes from debt? How much from equity? I know I'm way ahead of you on the project. But when you get here, here's what I'd like you to try out. Use those market values to come up with weights for debt and equity. Then use book values to come up with weights for debt and equity. You know why I want you to do that? As ammunition when the CFO says, I'm just being conservative, so you can show how much of a difference there is when you focus on market value weights. I'm ready to pull all my numbers together for Disney. This is the page I've been leading to for 150 pages. I know I haven't told you this. But this is the page that all of these things we've talked about for the last 10 sessions is going to give me for Disney. I need a cost of equity for Disney. I start with a risk-free rate of 2.75%. Why? Not because it's a US company, but because I'm doing my analysis in US dollars. Separate countries from currency. In fact, that's the thing that if you did problem 2 on the first quiz wrong, that's what I want you to think about. I wanted to ask, I asked you to compute a cost of equity in Brazilian reais or Colombian pesos. I didn't ask you to compute a cost of equity for Brazil or Colombia. So it's in US dollars, the risk-free rate is 2.75%. The beta that I'm going to use for Disney is 1.00. You say, where did that come from? Where did that come from? Remember I broke down Disney to 5 businesses, did a bottom-up beta. That's my bottom-up beta. My equity risk premium for Disney is 5.76%. What does that reflect? Where Disney does business. 82% in the US, 18% outside, so weighted average of the risk premiums. My cost of equity in US dollar terms is 8.52%. Let's move to the cost of debt. Risk-free rate, same risk-free rate. Make sure that's true for your cost of capital computations. Same base. The default spread I'm adding for Disney is 1% based on their actual rating. If I hadn't had an actual rating, I'd have computed a synthetic rating. If I trust neither, then I could have used the yield to maturity on a bond that is traded. So it's 3.75%. Times 1 minus the marginal tax rate. Marginal tax rate for Disney is about 36.1%. My after-tax cost of debt for Disney is 2.4%. Let me pause right there. What's equity costing Disney? About 8.5%, right? What's debt costing them? 2.4%. Don't take the next step. If you think about it, say, what the hell are they doing raising equity? Why don't they just borrow money? It's not that simple. Debt will always be cheaper for equity, no matter who you are as a company. But that doesn't mean replacing debt, equity with debt is going to make your cost of capital go down. Sounds like a mystery, but let it stay a mystery for the moment. We'll come back and resolve it. But that's my cost of debt. My market value of equity is just my market cap, $121.9 billion. My market value of debt is what we just computed. Interest-bearing debt market value plus the present value of leases, $15.96 billion. Based on those values, here's what it looks like Disney is doing. They're getting 88.4% of their capital from equity, 11.6% from debt, and their cost of capital is a weighted average of the cost of equity and the cost of debt, which is 7.81%. So at this stage, I have a cost of equity for Disney, a cost of debt for Disney, a cost of capital for Disney. And at this stage for Disney, I can go further, right? Because I have 5 businesses, I can give you the cost of capital for each of the 5 businesses, just like I did cost of equity. And this is, in a sense, the bonus I'm getting because I did bottom-up betas. The cost of capital for each of the 5 businesses is this, and you can already see how different it is, depending on the business you're in. It is as low as 6.6% for the theme park business, and it's almost 9% for the interactive gaming business. And that actually makes sense. Riskier business, you should have higher cost of capital. For Vale, remember I did everything in dollar terms. My cost of capital in dollar terms for the 4 businesses they're in, again using the same approach, bottom-up betas. The one difference between Disney and Vale is Disney actually tried to compute debt ratios by business, by allocating the debt. For Vale, I gave them all the same debt ratio. But the end result is I have a cost of equity and a cost of capital for each of the companies. And I also have a cost of equity and cost of capital for each of the divisions of each of the companies. And that's going to be useful when you start thinking about what's my hurdle rate for a project? How much should I demand? Any questions? Just to complete the process, I computed the cost of capital for my other 3 companies. For Tata Motors, I used their debt ratio, which is 29% debt, 71% equity. I'm doing everything in rupee terms. Their rupee cost of equity is 14.49%. Their after-tax rupee cost of debt was 6.5%. The cost of capital in rupee terms was 12.15%. And if I wanted to make it into US dollars, not a problem. Just take the inflation difference. I can make it into a dollar cost of capital. For Baidu, I did everything in Chinese yuan. 12.91 cost of equity, 3.45% after-tax cost of debt. It's 95% equity, 5% in debt. And that's why I said don't spend too much time finessing the cost of debt for Baidu. It's not going to make much of a difference in the cost of capital. And finally, for Bookscape, remember I estimated a cost of equity as if they were a publicly traded company. They said, oops, I shouldn't have done that. And the cost of equity as a private business, the total beta was much higher. I actually computed the cost of capital using both approaches. So you can again see the contrast, the disadvantage they face because they're a private business. The one question is, where the heck do you get a debt ratio for a private business? Remember for Bookscape, when I got to my unlevered beta, I did the same dance. I said, I don't know what the debt ratio is. And what did I end up using? The industry average. Basically, that's what I did here as well, is to stay consistent. It's much better with a private business to go to the publicly traded companies in the space, look at their debt ratios. And if you go to my website, I actually have debt ratios by sector. Just plug it in and come up with the cost of capital. It'll work far better than using book ratios. I have a cost of equity and a cost of capital for every company. And for every company, the cost of capital is lower than the cost of equity, right? Because I'm weighting it down with cheaper debt. And here comes a kind of puzzle, because I call my cost of equity a hurdle rate, right? When I came up with it. Now I have a cost of capital, which I'm also going to call a hurdle rate. And they're two different numbers. How can you have two different hurdle rates for the same company? And here's how you answer that question. So when you do your company, you're going to come up with a cost of equity, you're going to come up with a cost of debt and a cost of capital. And you're going to notice the same phenomenon, that your cost of capital is lower than your cost of equity. And I'm calling both hurdle rates. And here's the way you resolve the difference. If I'm looking at something with equity eyes, I'm focusing on the net income I make on the project, the cash flows I get as an equity investor, the return in equity I earn, then the hurdle rate is the cost of equity. If I look at the same project as a firm, both debt and equity being players, I look at return on capital, cash flows before debt payments, the hurdle rate should be the cost of capital. It's one of the first principles in corporate finance. You tell me what you're focused on, I'll tell you what the right hurdle rate, given that focus is. So if you have an equity focus, net income, cash flow to equity, then return on equity, the cost of equity is your hurdle rate. It sounds abstract for the moment. When we talk about projects, you're going to see them play out in terms of very different numbers. So they're both hurdle rates, but you can't just pick and choose whichever one you want to use, because it depends on what you're comparing it to make sure that it is in fact the right choice. So it took us a long time to get there, one box. But we now have a hurdle rate. And as I go through the statement that I gave you on the first day, let's see if we can flesh out some of the words. The hurdle rate should reflect the riskiness of what you invested. And how do we measure risk? With risk, you cannot diversify away with equity, which we capture with the beta, and default risk, which we capture with the spread in the cost of debt. To reflect the riskiness. The mix of debt and equity, how did that show up in my hurdle rate? 88.6%, 88.4% equity, those weights in your cost of capital. And that's the number you're going to see me go back to over and over again to answer the question, is this company a good company? Is it taking good projects? And when I look at a project, I need these hurdle rates as discount rates. One reason I do hurdle rates first is I still remember my first corporate finance class. And we did capital budgeting first. So we talked about cash flows and discount rates. So all through the first 5 weeks, discount rates came in through left field, right field, straight at you. And you say, where did that come from? Where did that come from? I said, don't worry about it. We'll talk about it later. And that doesn't make, you need to talk about hurdle rates first before you move into investments, looking at returns. So at least we've laid the foundation. So think about it. The best way you can nail this down is to compute the cost of capital for your company. And it's actually a lot less work than you think if you get started. If you don't get started, it's going to look like it's a mountain you can never climb. But you've got to take it incrementally. And if you take it incrementally, you can get a cost of capital for your company. You might even be able to go further and give me a cost of capital by business for your company. So now let's move to the second box. I want to get a return that you make on your projects. And I said the return should be based upon cash flows, should reflect when you get those cash flows and have all side effects built into them. I'm going to give you the recurring theme song you're going to hear for the next couple of weeks when I talk about returns, including your break week. You'll hear me as you're sleeping. Okay? And it's that line from Jerry Maguire. And I think it's Cuba Gooding Jr. who says this line. Remember what it was? Show me the money. Notice what he didn't say. He didn't say, show me the accounting profits. He said, show me the earnings. He said, show me the money. That is going to be the bottom line in how we think about returns. Don't play accounting games with me. This is about cash in and cash out. So I'm going to start off by talking about why we're so focused on cash flows in finance. But after all, we hire accountants. They spend weeks, months coming up with these accounting statements. We throw them all out of the window and we come up with cash flows. So I want to start off by explaining why I trust cash flows more than earnings. And then we'll start talking about how you compute cash flows for a project and how to convert those cash flows into returns. So let's start off with some very basic accounting. I'm not an accountant, in case you were wondering. And every morning when I get up, I get down on my knees and I look up at the sky and say, thank you, God, for not making me an accountant. But somebody's got to do this dirty job of working through the accounting numbers. And looking at accounting from the outside, there seem to be two broad principles that drive how accountants think. One is the notion of accrual accounting. What does accrual accounting require you to do? Record transactions as they happen, right? So if you sell something on December 30th and you have a calendar year end, I require you to show it as revenues this year, even though you haven't been paid for it. And I require you to look up the expenses associated with the revenues, even though you might not have paid for them yet. That's accrual accounting. You know what a much more honest way of doing accounting is? Called cash accounting. You're not allowed to do this as a company, but in cash accounting, or I call it checkbook accounting, here's how you prepare your financials. You show revenues as you get paid, and you show expenses as you pay them. You're not allowed to do cash accounting. You're required to do accrual accounting. So file that away. That's the first building block for accounting. The second is accountants have a fetish about classifying expenses. I still remember my first accounting class. My professor came in with 3 cardboard boxes. Obviously, he didn't spend a lot of money on his props, and these were his 3 props. And he had them labeled. The first box he labeled operating expenses. The second box he labeled capital expenses. And the third box was labeled financial expenses. And here's what he said. He said, into the operating expense box, I'm going to put any expenses associated with creating benefits just this year. So he said, you have labor, you have materials, they go into the operating expense box. Into the capital expense box, he said, I'm going to put in any expense that creates benefits over many years. Like what? Buying land, building a factory. And in the financial expense box, he threw in just one item. It said it's interest expense. Basically, it's expenses associated with the use of debt. And he said, in accounting, we're religious about the way we classify expenses. I didn't know then that he was lying. Because as we saw already, accountants are not that religious about this classification. Why am I saying that? What do they do with lease expenses? It should be in the financial expense box, but they say, I'll put in the operating expense box. Here's the other item that they routinely miscategorize. What did I say about capital expenses? Any expense designed to create a benefit over many years, right? So if I'm a pharmaceutical company, what's my biggest CapEx? R&D. And where does it go? It goes in the operating expense box. In fact, I spent 2 sessions in my valuation class disentangling this and redoing the financials for technology firms, pharmaceuticals. In fact, I've got to redo the financials for 80% of all companies because the expense is in the wrong box. But let's take them at their word. Capital, operating, financial. It's those 2 accounting characteristics that cause accounting earnings to be different from cash flows. If you gave me the accounting earnings for a company or a project, to get to cash flows, there are only 3 adjustments I have to make. Only 3. First, I have to add back depreciation and other non-cash expenses. Why? Because they lowered my income, but I haven't spent the money yet. It's an accounting expense, but it's not a cash expense. So I'm going to add that back. I have to subtract out capital expenditures. Why? Because even though the accountant says, oh, it's not an expense, when I went and bought the land, did I have to pay money for it? Capital expenses, you have to pay. Whether the accountant classifies an expense, it's cash outflow. So I'm going to subtract out capital expenses. And here comes the final adjustment. Remember accrual accounting, you sold something on December 30 and I made you record it as revenues right away, even though you haven't been paid yet. So what do you have to show on your balance sheet to reflect the fact that you haven't been paid yet? accounts receivable, right? Not deferred revenue, but accounts receivable. And if you haven't paid your suppliers, you show accounts payable. And if you use inventory you carried over from the previous year, you call it inventory and the adjustments in inventory. Working capital is the residue of accrual accounting. To convert accrual earnings to cash earnings, if I take the change in working capital and take it out, I've essentially made the conversion. So here's the total adjustment. You start with earnings, you add back depreciation, other non-cash charges, you subtract capital expenditures, you subtract out change in working capital, you have cash flow. So let's do a little what-if analysis, or a couple of scenarios. Is it possible for a company to report huge positive earnings and have negative cash flows? What kind of company will that be? Because we know there are 3 adjustments, so it's got to be in those adjustments. So what kind of company will have big positive earnings and negative cash flows? And tell me, but what is it about those companies that makes the cash flow negative? High capex, he said, but high capex by itself is not going to do it, right? Most companies with high capex also tend to also have what? High depreciation. So if you just have high capex and high depreciation, so the companies where you're going to see cash flows become negative are companies which have low depreciation and high capex. So let me come back to you. What has to be true about a company for depreciation to be low and capex to be high? What does depreciation reflect? Past capex, right? So if you're a growing company or a high growth company, you're going to see this happen, right? You're going to have depreciation added back, but your capex is going to be much, much larger. You can end up with negative cash flows and positive earnings. Can you have the reverse happen? Can you have a company with negative earnings and positive cash flows? In fact, this is the dream of every privately run company in Asia and Latin America. Report a loss. You say everybody thinks you're a loser, but what do you gain by reporting a loss? You don't pay taxes. Let me ask you a question. Would you be okay being labeled a loser if you kept being able to deposit $5 million in cash in the bank every year? I'm okay. Call me a loser. I'll go deposit the cash, and this loser is going to have a lot of cash to spend. So you can have negative earnings and positive cash flows. In real estate companies, the reason this happens is depreciation and other tax credits can account for a lot of stuff. So you could end up with negative earnings and positive cash flows. And what are we saying in finance? When the numbers are different, we should trust the cash flows. So let me start off by explaining why I trust cash flows more than earnings. Here's my first reason. It's going to sound absurdly stupid, but hang in there anyway. You cannot spend earnings. Try. Go over to the local Starbucks. Avoid this one right across the street that's like a line that's just 500 people long. Walk, there's a Starbucks. Just turn your T-Mobile around, see where you get a Wi-Fi signal. Just walk in that direction. About 2 blocks in either direction, you're going to hit a Starbucks. Walk in and order a venti cappuccino. How much is a venti cappuccino now? Like $5.50. Be very specific because sometimes they put stuff in there that you don't want. Offer to pay with earnings. Say, look, I'm in the MBA program at Stern. I have a lot of future earnings that I'm looking at. Can I pay with earnings? Unless you have a really stupid cashier, he's going to say, that's very nice, or she's going to say, it's very nice. I need to see some cash. You can't spend earnings, you can spend cash. And here's the other reason you shouldn't trust earnings. Winston Groom. You think, what the hell is he talking about? You guys heard of Winston Groom? I'll tell you, he actually wrote a few books. In fact, one of the books he wrote, you might have heard of, called Forrest Gump. 1980s, he writes this book. It's a little cult classic. Somebody at Paramount reads the book and likes it. Says, I want to make a movie out of the book. They come to Winston and say, we'd like to make a movie out of the book. He's very flattered. Somebody wants to make a movie out of a book he's written. So they give him a contract to sign. And he looks at the contract. It looks pretty good. It entitles him to 5% of the accounting profits on this movie. Mistake number 1. There's a little footnote next to accounting profits, and at the bottom it says, these accounting profits will be computed using studio accounting standards. Mistake number 2. He signs a contract. Mistake number 3. Movie gets made, not a mistake. Tom Hanks stars in it, becomes this huge hit, one of the 10 highest grossing movies of all time. And Winston's at home waiting for the check, and it doesn't come, and it doesn't come, and it doesn't come. And finally, he says, maybe they lost my address. So he calls Paramount and says, where's my 5%? They say 5% of what? the profits you're making on this movie. They said, we're not making any money. We're losing money on this movie. So how can you be losing money on the 10 highest grossing movies? I said, come on in and take a look at our books. He comes in and takes a look at the book. And so the bottom line is it's a loss. And he looks down the expense items, and he sees an expense item for $160 million. He says, what is that? He said, that's a provision. For what? For future bad movies. Studio accounting standards actually lets you set aside a portion of the revenues on a successful movie to cover future bad movies. Now this might explain some phenomena we've noticed, right? Maybe this provision gets really big for some companies. It's November. They say we have to make some really bad movies really fast to get everything. Let's call in Eddie Murphy. He's really good at doing this kind of stuff. Right? There's a whole list of stars you call. They're able to burn through any amount of money in no time at all. But let me ask you a question. Do you think Paramount made money on Forrest Gump? Yes. So is this fair to Winston Groom that he didn't get a share of that money? Depends on your definition of the word fair. He sued. Case didn't last very long. The judge read the contract to him and said, Mr. Groom, is this the contract you signed? He said, yes. Basically put your fate in the hands of accountants. Is that true, Mr. Groom? He said, yes. You got what you deserved. Case dismissed. Okay. I get reminded of this every 6 months. And you're going to be the beneficiaries of the frustration I feel. I have 11 books with 3 different publishers. They all screw me over. I could tell the story about any of them. But my contracts look really good. I'm entitled to 15% of the net proceeds on this book. The accountant invented the word net. Should be tarred, feathered, and hung from a tree. 15%. Any of you bought the Applied Corporate Finance book? It's obscenely overpriced for a paperback, right? In fact, it's so obscenely overpriced. I remember when it got published, you're allowed to buy 20 copies of the book from the publisher at a 30% discount. I placed the order, and at the very end, the pleasant lady comes on and says, that'll cost you $2,200. And I said, I don't want the book. You keep it. I'm not paying $100 per book. It's obscenely overpriced, but I should be getting rich off you guys, right? $15 per book. So every 6 months when I get my royalty statement from my publisher, here's what I do. I take the check, the total amount. They tell me how many books I sold. I take my royalty and divide by the number of books to see how close to $15 I get. You know, most I've ever got per book is $1.50. Many a slip between the gross and the net. There are line items I say, what the hell is that? I'll tell you my least favorite line item. Every year I lose about half my royalties to a year-end adjustment. What the hell is that? Year-end adjustment. The end of the year came up on you unexpectedly. Let me give you a clue. If it's October, the year-end is coming, and what exactly do you do at the end of every year? Throw half my books into the Hudson? So I remember the first time I got this, I called my publisher and I said, I need to talk to somebody about this year-end adjustment. Half my royalties are disappearing. She put me in touch with the legal department. And guess who I'm talking to next? A lawyer. And 25 minutes into this conversation, I know it's not going well. I've forgotten what I called about. He asked me on the defensive saying, why only half of your royalties? We should be taking 75%. He asked me to look up clause 7C in the contract. I have no idea what it says. It does mention the end of a year and an adjustment. Beyond that, it's complete legalese. So finally, I hang up on the guy. And I plot my petty revenge. So here's how I write my books. I write them in Microsoft Word, and every chapter that I write, I make a PDF version, I put it online, ostensibly to get feedback from people reading the book so they can fix mistakes. So my investment valuation book is 35 chapters. Chapter 1, Chapter 2. Then I get to Chapter 35, the whole book is done. I send it to the publisher, it gets printed, it goes into bookstores, and I forget to take the PDF files offline. The first time this happened, I get a call from a publisher. I knew exactly why he was calling, but I said to act all innocent. I said, you seem upset, what's going on? He said, your entire book is online. I said, so? So you're going to lose royalties. I said, what do I care? I make $1.50 a book. If I made $15 a book, maybe I'd care more. Call me when that's true. He hasn't called me back since. So all of my books are actually online. I just have to make it look like it was accidental. So one of the books I think is hidden. I use Mexican menu items often to hide my books. I think one of the books is behind enchilada. You click on enchilada, the whole book comes out. And my response when my publisher goes, I don't know how that happened. I was putting up Mexican menu items, and next thing you know, books are flying out. Okay? So if you get a chance, go online onto my site, look for Mexican menu items. Quesadilla, taco, enchilada. Before you're done, you're going to have all 12 bucks. Okay? And don't worry about depriving me of the royalties. It's only $1.50 a buck. It's not $15 a buck. In fact, this was cemented finally for me when I was in Hong Kong airport waiting for a flight. It's a while back. And the flight was delayed. I decided to go hang out in the bookstore, and especially in the section of the bookstore where there are the investment and valuation books, because there's nobody usually there. You can put your luggage, you have lots of room. And I'm looking at the valuation books, just checking out the competition. There's a book on valuation, I pick it up. I start reading through it. I read the first paragraph. It's oddly familiar. Then I read the second paragraph. It's almost like I wrote it myself. Then I read the third paragraph and said, this is my book. I turned to the front. It's not my name. It turned out that somebody in Hong Kong had ripped off my book and I got back home. I called my publisher and I said, you know what? My book is floating around in Hong Kong. Somebody else's name is there. He said, well, I can't do much about it. And that's when I said, why should I let some guy in Hong Kong rip me off when I can rip myself off? So when you download the book for free, you're just ripping off that guy in Hong Kong. Feel good about, no, this is a blow for intellectual property rights around the world. You're doing something good. The only piece of advice I would leave you is these books are incredibly hefty. It's like 1,500 pages. If you're going to print the book off, print it on somebody else's printer. Your printer will get burnt out by the time it's done. So it's going to be cash flows I'm focused on because you can spend only cash. Second, I'm going to focus on what I call incremental cash flows. What I care about are cash flows created by a project, not cash flows that have been there anyway. That sounds obvious, but you'd be amazed at how many line items in project analyses you should be taking out. And third, I'm going to time weight those cash flows. Sounds fancy, right? But I don't know whether any of you have an old finance book. In the old finance books, towards the end, there was a present value table. And a present value table, you see what the value of a dollar is in 1 year, 2 years, 3 years. So you'll say, dollar in 1 year is worth only 91 cents. In 2 years, so you'll see, that's time weighting, right? Discounting is time weighting. So my measure of a good return is it's got to be a time-weighted, incremental cash flow return. Now, this is the only part of the class where I basically have to make up stuff because the rest, I need to do capital structure. I can look at the numbers from the company. These are companies don't tell you much about internal projects, but everything that companies do is really a project. So let me give you my definition of what a project is, and you're going to see how widely I run. To me, a project can include any decision you make to enter a new area of business. So if Disney decides to enter interactive gaming, that's a project. If Amazon decides to enter the delivery business, that's a project. Acquisitions of other companies are really big projects. But you can have really big projects, you can go all the way down to smaller projects. A decision by the Gap to carry only 6 colors rather than 7 in a store is a project. To me, everything that companies do essentially becomes an investment decision. So I'm going to go through 4 investment decisions in this class, kind of ranging the spectrum. First, I'm going to concoct a new theme park for Disney, and I'm going to call it Rio Disney. And guess where I'm going to put it? In Rio. I'm very creative. And so basically, I'm going to give you all the details of this project, and I'm going to ask you to be the decision maker. I'll be your number cruncher, and along the way, you'll be called upon, would you take this investment with you at Disney? Second, for Vale, I'm going to look at a new iron ore mine that they're thinking about opening in Canada. Why in Canada? Because there's a lot of iron ore in Canada. So that'll force them to leave their domestic domain. So we're going to have to look at what are the criteria you would use if you're opening a new iron ore mine in Canada. For Bookscape, I'm going to talk about creating an online store. Remember, they're a traditional bookstore, then maybe they can sell books online to supplement their revenues. I'm going to take you through the process of looking at that decision. And finally, I'm going to look at Tata Motors and look at a potential acquisition of a company called Harman. It's a publicly traded company. It makes sound, speakers, headphones, etc. You're saying, what did an automobile company require with it? They want to put some high-end sound systems in their Jaguar Land Rovers, and they're going to buy the whole company. So I'm going to take you through that process. 4 very different projects. But let's start with the Disney project. Before I start with the Disney project, I have a question. Who in this room has never been to a Disney theme park? Okay. Have you seen these Super Bowl ads? Eli Manning, you just won the Super Bowl. you should go to Disneyland. So maybe after this class is over, we should collect some money and send them to Disney, right? But even if you've never been to a Disney theme park, you know that every Disney theme park is built around a Magic Kingdom, right? And what does a Magic Kingdom always have as its front? A castle. I could embarrass you by asking whose castle it is. I'm going to embarrass you by asking whose castle it is. Whose castle is in the foreground? I heard Cinderella. Is it Cinderella? It's Sleeping Beauty in Disneyland. It's Cinderella in Disney World. It's Belle in Euro Disney. I have no idea who it is in Tokyo Disney. There's no Snow White castle. That woman never had a castle. She lived in a hut with 7 dwarfs, right? So it's a castle. The castle is usually fake, but that kind of goes with the territory. It's Disney, it's usually fake. You walk through the castle, and where are you? The happiest place on earth, right? You're surrounded by parents dragging screaming kids around, but it's the happiest place on earth. Right in front of you is the Dumbo ride. I don't know why people stand in line for that ride. It's hopelessly overrated, but it's right in front of you. And around you is all the other rides, classic Magic Kingdom. So this Rio Disney theme park is going to have a Magic Kingdom. That Magic Kingdom is going to take a year to build and be operational at the start of the second year. The second theme park that's going to go into Rio is going to be a variant on Epcot. Have you ever been to Epcot? It's one of the creepiest places on earth. First, there's an artificial lake, but I told you everything in Disney is fake, so it's an artificial lake, surrounded by the world as Disney sees it, which is usually a pavilion and a restaurant for every country. The restaurant is actually bigger than the pavilion, but there are some countries they miss along the way. I remember the first time I went to Epcot, you can actually walk around the world. This is for somebody who never wants to get on a plane and wants to see the world. You go to Epcot, you see China, you eat Chinese food. You see Mexico, you eat Mexican food. Basically, you can eat your way around the world in about 3 hours. But the first time I went around, I noticed some missing countries. I'm not talking about Slovenia, which is where my wife is from. It's easy to miss. 3 million people, you kind of, okay. But the first time I walked around and said, where's India? How do you miss 1 billion people? Well, we'll give them, so maybe this Epcot, they're going to fix that and have at least an India pavilion, at least have an Indian restaurant. Forget about the pavilion, right? So there's going to be an Epcot. That's going to take longer to build because remember you have to put an artificial lake in the middle of Rio and make sure the criminals are not chasing you around the lake while you're out, right? That might add to the excitement factor. So this Rio, the second theme park, is going to take 3 years to build, be operational at the start of the 4th year. I'm going to be a number cruncher, and I'm going to cheat and give you all the numbers for this theme park in US dollars. Why is that cheating? Because the actual revenues and earnings are going to come in reais, but I assume as a Disney decision maker, you're much more comfortable with dollars, so I'm going to give you all the numbers in dollars. After I've done the analysis, I'm going to ask, would your decision have been different if I'd done everything in reais? But let's hold off on that. So the first step in this process, I'm going to give you some of my key assumptions. Disney has already spent $500 million doing the research, getting the licenses agreements. Keyword is already spent, and if you decide not to take the theme park, that $500 million is gone. So file that away. It's money you've spent, but you've already spent it. The theme parks themselves, Magic Kingdom is going to cost $3 billion, $2 billion spent right now, as in today, and $1 billion to be spent a year from now. Epcot is going to cost $1.5 billion, with $1 billion being spent at the end of the second year, $500 million at the end of the third year. So I'm being very specific about the cost of the theme park. The $4.5 billion spread out over 3 years. These investments, these big investments, are capital expenses. They're going to be depreciated based upon some tax code somewhere. Here's what my key revenue assumptions are, and at this stage I'm going to confront you with a question. Let's suppose you are the number cruncher, and I'm your boss, and I say, come up with some numbers for the Rio Disney theme park. Remember, the first thing you start off with is an empty spreadsheet, right? So how do you come up with projections of revenues and expenses for a new theme park if you're at Disney and the theme park hasn't even opened? What are you going to look at? Is this the first time Disney's done something like this? No, there's Disneyland, there's Disney World, there's Euro Disney, there's Tokyo Disney, there's Hong Kong Disney. What can you glean from that? I know Rio is very different from Orlando and Anaheim and Tokyo. But still, you can glean some information on how many years does it take before the theme park gets to pull the maximum number of people. How much can you charge? How much do they spend in the theme park? I know you're taking a risk here because you're extrapolating from US and European theme parks to a Latin American theme park, but there's no choice. You have to make your best judgments. And these are my judgments as your number cruncher on what the revenues will look like. In year one, there are no revenues. Why? Because you're still building the theme park. Maybe I could have been creative and charged you to watch the construction. Hey, who knows? People pay for all kinds of crap. Right? In this case, I wasn't that creative. The revenues are 0 in year one. Starting in year 2, you see the revenues kick in Magic Kingdom, and they climb very quickly till about year 4, because that's initially you don't get full, because you're testing things out, but over the next 4 years it starts to build up. So there's Magic Kingdom. Starting in year 4, you see Epcot kicking in. And the collective revenues are the sum of those 2 theme parks. Plus the resort properties. What are those? What am I talking about? Things like the Swan, the Dolphin, what you surround the theme parks with. I mean, these are hotels that people stay in because they want to go to the theme park. And I've estimated the revenues there to be 25% of the revenues you make in the theme parks. Saying, why 25%? Because that's what they make in Orlando and Anaheim, is for every dollar spent in the theme parks, they get 25 cents in the hotel. So I am extrapolating from that information to what they will make. There's my collective revenue, starting at 1.25 billion, ending in 4. Remember, you're the decision maker, so watch these numbers. That looks pretty good, right? Almost $500 million in revenues by the end of the 10th year. But that's just the revenues. For the expenses, here's what I'm going to assume. At the theme parks, the expense will be 60% of the revenues. Why? Because that's what they spend right now at the regular theme parks. And these are the direct costs of maintaining the theme parks. So these are all the people who staff the theme parks, keep it working, keep the lines. 60% out of every dollar goes into expenses. At the resort properties, the margins are slimmer. For every dollar they make at the resort properties, they get to keep about 25%. So basically 75% of the revenues go into direct expenses. But this is a project for a big company, right? And if any of you worked at big companies, you notice that there are entire expense items that have to be allocated. It's called G&A costs. And Disney, in this case, is going to allocate G&A costs to this project. Let me step back. What exactly are G&A costs? I mean, you see them in every company. General and administrative costs. What do they capture? Not all salaries go in there, right? Salaries which can be traced to your salesman don't go into G&A costs. I told you I don't know how many of you worked in big companies, but if you worked in a big company, you worked in one of those big buildings, you notice there are entire floors filled with people who had no idea what they did. They came in, they went into these floors, they claim to be working, but no revenue comes out of these floors, all expenses. And that drives accountants crazy. So here's what they do. They gather all these expenses, they put them in a pile, and they go looking for somebody to attach them to. Oh, you have revenues here? Have some. I say, no, please, I don't want them. No, it's not a choice. If you have revenues, I'm going to put the expenses with you. So these are expenses in search of revenues. You know what's in there? Bob Iger's salary. Let's face it, Bob Iger does not generate $1 in revenue. So if you pay him $15 million, it's got to go somewhere. And this project looks like it's going to have revenue, so I'm going to attach 15% of the revenues as a G&A cost. But I'm going to add something. 2/3 of these expenses have nothing to do with this project. And if you don't take this project, guess where they're going to go? Somewhere else in Disney. So file that away for the moment. Say, who cares? But I'm allocating expenses, but I'm also saying 2/3 of those expenses are going to be there anywhere. Finally, for the depreciation. For much of the last 20 years in the US, probably more, 30 years in the US, your choices on depreciation schedules. It used to be in the old days you could use straight line depreciation, accelerated depreciation, some of the year digits depreciation. For much of the last 30 years, the IRS actually gives you tax schedules, which tells you what percentage of your asset you can write off every year. So in this case, based on the assets Disney is investing in, this is what the depreciation is going to look like by year for the next 10 years. But when you depreciate, what are you doing to your assets? Basically, you're depleting the assets, right? I know it's accounting depreciation, but in theory, what depreciation captures is each year an asset is used, it starts to age. Like what asset? That Dumbo ride. In year 1, it looks brand new, right? In year 2, if you take the depreciation, you just let it run, it's going to look a little older. And at some point in time, if you don't put any money back, guess what's going to happen to the ride? It's going to be decrepit, stop working. So some of what you are putting into depreciation, I'm going to put back in to maintaining those assets. That's called capital maintenance, as opposed to traditional CapEx. So these are the rides you see shut off at Disney. Sometimes when you go into Disney, there's a ride that's shut off. We're doing renovations, new ride. That's what capital maintenance is. Essentially keeping the park looking new 6, 7, 8 years. You're saying, why am I doing this? Because I want this park to keep going. I don't want to stop after 10 years. If my plan were to end the park after 10 years, I wouldn't be putting all this money in. So I'm depreciating and putting some of that money back, at least initially, and then towards the end I've got to put more and more, because as the theme park ages, the amount I have to put back to maintain it is going to get higher and higher. And to me, capital maintenance is always best scaled to depreciation, because depreciation is what you lose. The best way to think about this is like being on a diet, right? Depreciation is like calories burnt off. And capital maintenance is like what you eat. So if you just keep burning off calories, you're just going to drop in weight and just drop dead one day. So capital maintenance is what you put back to keep your weight at a reasonable level. Final assumptions. There are working capital requirements on these properties, which are going to be about 5% of revenue. So this is inventory, accounts receivable, etc. And that working capital investment has to be made at the end of each year. So what does that even mean? As opposed to the beginning, the timing is going to make a difference as to when I show that investment. All of the income from this investment is going to be taxed at a marginal tax rate of 36.1%. So here's what I'm going to do. I'm going to take all this information and I'm going to compute first the accounting earnings on this theme park. You're saying, but we said accounting earnings don't matter. Might as well start with earnings and then we'll move to cash flows. So here's what the accounting earnings analysis will lead with. First, if you look at what I've invested in this theme park from an accounting perspective, remember how accountants record book capital. Anytime you make a capital expenditure, it goes into book capital. Anytime you have depreciation, it goes out. So every year I keep track of what the accountant will call the book value of the assets on this theme park. So in year 1, my book value of assets is just the $1 billion I invest in the theme park. Plus the $2 billion that I invested right away, so $3 billion. So each year I keep track of what I've invested, netting out depreciation, adding back capital maintenance. You're saying, why do you care about this? You'll see me use this later, because this measures what the accountant tells you you've got to invest in the theme park. And in fact, I'm going to also add the working capital each year, so you get a measure of the total capital you have tied up in the theme park. So that's what you've invested in the theme park, but that's the less interesting part, right? What you also want to know is how much money you will make on this theme park. And here's what I did to compute your earnings on the theme park. I projected out the revenues. I subtracted out the expenses, 60% of the theme park for direct expenses, 75% for the resort properties. I subtracted out depreciation and amortization because it is an accounting expense and I'm doing accounting earnings. And I subtracted out the allocated G&A costs. See that bottom line, operating income? In year 1, I have an operating loss of $50 million. No surprise, because the park is not even operational, I have just expenses. And I show a tax of plus 20. What am I assuming Disney is going to be able to do in year 1 when they lose money on this project? What are your two choices when you have a loss? One is you can carry it forward and set it off against income in future years. But that means you've got to wait to get the tax benefit. But if you're Disney, a company that makes money on all of its other projects, and this is just a new project you've added, and you make a loss on this project, guess what you're going to do? You're going to offset it against income on other projects, and you're going to reduce your taxes right away. That plus 20 million is what I save on taxes as a company elsewhere because of a $50 million loss. That loss gets larger in year 2, $150 million, I save on taxes again. Year 3, $84 million loss. And then I start to make money. So if this were an accounting break-even question, and I ask you, when do I break even? Your answer is going to be in year 3. It looks like you break even. Or year 4. It looks like you break even. But that's really a very low threshold. Do you see why? Breaking even just means you're making $1 in profits, but you have $5 billion invested in this theme park. Making $1 doesn't make you whole again. So in this case, I'm going to project out income, and over time, as the theme park ages, my income goes up. Partly because my revenues are increasing, partly because my expenses start to level off, and partly because the depreciation is starting to wind down. So my project goes from a money losing to a money making project. If I gave you this statement and said, would you take this project? Would you be able to make that decision? It's a profitable project. It's making $421 million in after-tax income. Why are you so greedy? Wasn't that good enough? What am I not telling you? I've told you the hurdle rate is a separate question. You're making a lot of money, but relative to what? If you have $50 billion invested in this theme park, $450 million sounds like a lot of money, but relative to what? So what I did was I took your after-tax operating income on that page, and remember the book value of capital I computed, and this is why I computed it. From an accounting perspective, if you look at what you're making on this project, you divide the after-tax operating income by the book value of capital, you get what's called the return on capital. You can compute it using the starting numbers or the average numbers, but this is an accountant's measure of how good this project is. The return on capital, not surprisingly, starts negative, then becomes positive. The average return on capital across the life of this project is about 4%. Is that good enough for you? What do you need to compare this to in order to make a judgment? Now I'll give you some choices here. So you saw how I computed the return on capital, right? I took the after-tax operating income, I divided by the total capital invested in the theme park. I came up with a return on capital of 4.18 or 4.11%. I'm going to throw some hurdle rates at you, and you tell me whether this is what you'd compare it to. You could compare it to the risk-free rate, 2.75%, and say this is a good project. Why is that not right? Because it's a risky project. I shouldn't be comparing to the risk-free rate, right? I could compare to the cost of equity. Actually, let me pause there. Should I be comparing to the cost of equity or the cost of capital? I kind of threw out the rule for that. How did I compute the return for this project? I didn't look at net income. I looked at after-tax operating income. I didn't look at book equity invested. I looked at total capital invested. What I computed was a return on capital on this project. And because I computed return on capital, I should be comparing it to the cost of capital, not the cost of equity. So final question. It's got to be compared to cost of capital. Should I compare to the cost of cap for Disney as a company, which is 7.81%, or the cost of capital for Disney theme parks? We already kind of answered this last session. Remember I came to you with the movie project and I said, which one did you use? So we're almost there, right? Cost of capital is what I should use. The cost of cap for theme parks is 6.61%. I will leave you with one final thought, and we will talk about this when we come back. Actually, we'll talk about it now. Why let it hang over us? The one problem is that cost of capital comes from looking at theme parks that Disney already owns, and they happen to be, at least in 2013, in the US and Europe substantially. Hong Kong was just starting to kick in. And this theme park is going to be in Rio. You think, so what? Remember country risk premiums? That wasn't some abstractions we did just for Brazilian companies. This is a Brazilian project. So rather than use the 6.61%, I should be incorporating some of the risk of this being a Brazilian theme park into my cost of capital. It's not currency risk I care about. It's country risk, the fact that this is a risky country. So here's what I did. I threw in the risk premium for Brazil into, so everything else, risk-free rate is still US dollars, it's still in dollars, same bait, it's still a theme park investment. I threw in the country risk premium for Brazil instead of the 5.76%. That pushes up my cost of equity and pushes up my cost of capital. That becomes my threshold for this project. So I need to make 8.5% on this project, or 8.46% for it to break even. It's making only 4.1%. So we'll pause there for the break, and when we come back, we will talk about converting accounting returns to cash flows and time-weighted cash flows.
another question on this step right here. The cost of equity, I understand you added the credit risk in, but also in our cash flow analysis, do we need to calculate any foreign currency risk at all, like foreign exchange risk, considering the business is based in the U.S.? Because if you're bringing money back into the U.S.
Your investment is
Okay.
stocks, strong, like, half of the list,